Hello and welcome to Session 11 of the Basic Tax course. We're going to begin Session 11 with a review of the Session 9 quiz answer key. I have the quiz and the answer key for Session 9 on the screen in front of you. And the first question we're going to take a look at for frequently missed questions is question number 4. It reads, political contributions made to a political candidate or a campaign committee are deductible as a charitable deduction on Schedule A. This is a definite no, not even close to a maybe yes. Political contributions are never tax deductible on the federal return. Not only that, you have to be on the lookout for charitable organizations that are not approved as 501c3s. And if they're not approved as 501c3s, then they're not approved for deductibility on Schedule A. Two examples that come to mind of organizations that most of the public would clearly think of as charities with a nonprofit cause that could be commended are the Sierra Club and Greenpeace. And while both of these organizations are environmental in nature, they have been deemed to be political in their causes as well, and therefore donations to those organizations are not typically tax deductible. Sometimes there may be local chapters or subgroups of these major organizations that are tax deductible, but for the most part, you should be on the lookout for letterhead from a charitable organization that says it is a recognized 501c3 and that its contributions are deductible. If your client cannot produce such a letter, you can, of course, consult IRS publications and listings for more information as to whether a particular charity is a qualifying charity. But in general, if your client tells you that they donated $100 to the presidential election campaign, it's not going to be deductible, period. Moving on to the next item in line, question number 6. An appraisal fee you pay to determine the fair market value of an item you donate to charity is deductible as a charitable expense. That is a definite no. Sometimes the IRS does require an appraisal. If you donate an item that is a non-cash item that is valued at $5,000 or more, you do require a qualified appraisal in order to claim a deduction for that. And the cost of that appraisal is deductible, but it is deductible as a miscellaneous itemized deduction subject to the 2% limit. And we'll learn more about that in our Session 11 content today. But for now, just the appraisal fee in general of any kind is not deductible, especially as a charitable contribution. The next question in line is question number 15. You can claim a deduction for your interest expense on money you borrowed to buy tax-exempt securities. Well, that's a definite false. IRS says if they cannot tax you because your income is tax-exempt, so tax-exempt interest, for example, if you have tax-exempt interest income, you're not going to be able to deduct any expenses associated with the generation of that tax-exempt income, including investment interest expense relating to that. So, for example, if you have a margin interest account and you pay interest on that account, and then that account was used to purchase tax-exempt securities, then that portion of your margin interest would not be deductible. And the next question in line is the mini problem. This is a fairly complex mini problem, and lots of students had problems with it. We're going to break it down into some component parts, and then I'm going to show you the answer key associated with it. But the thing that gave people the biggest trouble was the margin account interest deduction and how much was allowable. But let's just take it from the top. Donald had the following expenses for 2011. Pre-tax medical insurance premiums. I've highlighted those in red. Red means no, you can't deduct it. When it's highlighted in green, it is deductible, and those include prescription copays, reading glasses, and dental visits. Those three amounts there are deductible, and you can see that they total, was it $500, $750. Then we have state tax that was withheld on his W-2 of $6,000. That is deductible, as well as state estimated tax payments that he made during the year. We also have a deduction for property taxes paid in the amount of $4,000, and that's allowed too. Then we come to this margin interest one. Margin interest is deductible. It is a form of investment interest, but it is only deductible to the extent that you have investment income. Well, did Donald have any investment income? The answer is yes, he did. He had interest income of $400 and dividend income of $400. So $400 plus $400 is $800 of investment income. His margin interest totals $1,000. That means his deduction is going to be limited to $800, and he will have a $200 carry forward to 2012. Donald also has home mortgage interest in the amount of $15,000, and then he made some contributions to charity. Down here we have a cash contribution to charity. The charitable organization is the Chamber of Commerce, and you cannot claim a deduction for charitable contributions to the local Chamber of Commerce, so that's a no. Then he had used clothing, more cash to his church, used Jetta, and 100 books to the public library. Those are qualifying organizations. The donations are deductible. In the case of the cash contribution to his church, that can go directly on Schedule A, but because all of the other non-cash donations totaled more than $500, he's going to have to complete a Form 8283 to figure the amount of his deduction and then enter that on the Schedule A. So your job was to complete Donald's 8283 and his Schedule A for him. So let's take a look at that finished return. And to begin with, here is Donald's Schedule A. The starting point was to enter that $750 of medical expense. You can see that I highlighted in green right here. That carries to line 1. Clearly, 7.5% of his AGI is a much larger number. His deduction for medical is 0. Moving on, we have his income tax deduction, and that's comprised of two parts. One is the $6,000 of withholding on his W-2, and the other is $1,900 of estimated tax payments that he made during the year. So $1,900 plus $6,000 is $7,900, and that is the amount that we entered on line 5, and we check box A. Next in line, we have real estate taxes. Those were $4,000. So his total deduction for taxes is $11,900. Mortgage interest of $15,000 was relatively easy. You can see here on line 14 we've entered the investment interest deduction in the amount of $800. Form 4952 is required, and we have prepared it. It is in the answer key for you. Let's just scroll down to it. Here is the 4952. Although we did not ask you to complete this as a part of your assignment, it should not have been difficult for you to figure out that $800 was the allowable amount. However, of course, most people miss this problem because of this particular aspect. So the $800 limit is in play. So the total investment expense for the year is $1,000. The total investment income is $800. The allowable deduction is $800. The carry forward to 2012 is $200. And again, $800 is entered on the line. So total interest deductions for Donald Duck are $15,800. Next in line, we have the $1,500 contribution to the church on line 16 of Schedule A, and on line 17 we have $4,600 of total itemized deductions. Let's take a look at Form 8283. Here is the 8283, and we can see that we've listed the names of the organizations, the addresses, and we've entered descriptions of the items donated. On the following section, we have entered the date purchased, the date donated. We've entered the cost basis. We've entered the fair market value and the method we used to arrive at that cost. So that concludes the review of the Session 9 quiz answer key. It is now time to take a look at the Session 10 homework assignment. So now it's time to take a look at the homework assignment for Session 10. In Session 10, I'm really starting to throw more complex information at you in a format that requires you to think. And part of being a great tax preparer is being able to think and decipher information that's coming to you basically in a haphazard way. So from this point on in the course, you're going to see more and more information being thrown at you in not necessarily in code, but just in a vernacular that would be used by your clients, or in an interview format where you would be asking your clients to provide you with information that you need. So your job is to read through the problem and then decipher the meaning of the problem as you go. So let's try that together. And I've got the problem here on the bottom right-hand corner of your computer screen. The answer key is up on the left side in larger print. Jonathan Livingston is married to Joanne, and I give you their dates of birth, and of course you need to decipher how that's relevant. Do they qualify for higher standard deduction or tax benefits because of their age? And their daughter, Tracy, born in 1984, is not a student. She lived with her parents all year, is their dependent for all intents and purposes, but because she earned $4,500, she fails the gross income test, so she will not be their dependent on their tax return. Jonathan works as a flight instructor for 2 different employers. He worked mornings in Des Moines and afternoons in Windsor Heights all year. This is Iowa. His commute miles in 2011 totaled 5,000 miles. Well, why would I give you that information? I gave you the information because you need it to enter on Form 2106. And as a tax preparer, you would need to be asking your clients for that same information. I also tell you that the round-trip commute distance is 22 miles, and he drove from his job in Des Moines to his job in Windsor Heights 6 miles, and from his job in Windsor Heights to his home 6 miles, 250 times during the year. So let me see, 250 times he drove from his first job to his second job, and that was 6 miles, and then he drove from his second job home, which is another 6 miles. Well, we know from the rules on commute that the drive from the second job home is not deductible, but that the drive from the first job to the second job is deductible. He drove 6 miles 250 times during the year. Then I tell you that these trips were split equally throughout the year. Why is that important? Well, it has to do with the standard mileage rate in 2011. We had two rates. We had 51 cents per mile for the first half of the year and 55.5 cents per mile for the second half of the year. So let's see how that translates in our answer key. We have 250 trips times 6 miles. That's 1,500 miles. 6 miles times half the trips is 125 trips, and that's 750 miles. We multiply that by the mileage rate for the first half of the year, 51 cents, and we get $383. This same formula, 6 miles times 125 trips equals 750 miles, but multiply that by 55.5 cents per mile for the second half of the year for a total of 416 miles. Going back to the problem, it also says that Jonathan drove his car a total of 15,000 miles in 2011, and he began using his car for business on January 1 of 2009. That information is provided for you so that you can enter it on the Form 2106 and also calculate any percentages you might need if you need to figure percentage business use. Jonathan also drove his car to a pilot instructor school in Davenport. He stayed 2 full days and nights and spent $94 on meals. The school cost him $500 and hotel cost $200. Now you should note that there was a distance that he drove, that's 338 miles, and so that brings us over to the next mileage topic. 338 miles on that trip to Davenport times 55 cents per mile gives us $188. So now we've got three amounts. We have $416 plus we have $383 plus we have $188. When we add all of those up, we get $987 for auto mileage using the standard mileage rate for Jonathan for 2011. The next item regarding mileage is the commute miles, and you can see that he drove 250 times from his second job home times 6 miles. That's 1,500 commute miles for the year. Now we are going to calculate Jonathan's business use on his vehicle. We have 1,500 business miles plus 338 business miles for a total of 1,838 business miles. And we divide that by 15,000 total miles to get 12.25% business use. Now, the next part in the wording of the problem is, of course, this meal amount. And we tell you that you spent $94 on meals, and we don't provide you with any per diem information. But so a clever tax preparer will go to the GSA website just to make sure that there isn't a higher per diem rate available. So I'm going to select fiscal year 2011. I'm going to click on Iowa. And the chart will then give me the per diem rates for fiscal year 2011. You can see that the standard per diem rate for most parts of Iowa is $46 a day. There are only 3 high-cost counties, and Davenport is not in any of them. Therefore, Davenport gets $46 a day. 2 days times $46 is $92. That's less than the actual cost of the meals that were purchased. So ultimately, that meant that we decided to go with the actual cost of meals for Jonathan. The next step is to fill out Jonathan's 2106 form, so let's go do that. We're going to begin Jonathan's 2106 on page 2. We enter the date the vehicle was placed in service as asked for on the form. We enter the 15,000 total miles. We enter the 1,838 business miles and the business use percentage at 12.25%. The average round-trip daily commute given to you in the wording of the problem is 22 miles. You can see right there, round-trip commute distance is 22 miles. And the commuting miles included on line 12 are a total of 5,000. And we didn't give you 5,000 in the wording of the problem, but we gave you enough information that you should have been able to figure it out. And then we have all other miles for the year, 8,162. That's simple math. You take 15,000 total, subtract out the business, subtract out commute, and what you're left with is everything else. We also answered the questions listed on lines 18 through 21. And we've entered the total deduction for mileage expense on line 22. That's $987. Now we go back up to page 1 of Form 2106. Line 1 asks for that $987 entry. We enter the travel expense, and in the wording of the problem, we tell you that the hotels cost him $200. That's where we got the amount on line 3. And we tell you that his other business expenses were $500, and that's the amount that he paid in tuition for attending the school. His total business expenses are $1,687, with the exception of meals, which are entered in column B at $94. We then take that $94 amount, apply the 50% limit, and we get $47. We add that to his other business expenses, and we end up with $1,734. Moving back up to the Schedule A, we're now going to make use of the other information provided in the wording of the problem. And we're telling you that the Livingstons had no employer-provided medical plan during the year and that the insurance premiums were $7,176. We also told you in the wording of the problem that paid $3,200 for Tracy's eye surgery. So even though Tracy is not a dependent because she fails the gross income test, the Livingstones will be able to claim the amount that they paid for her medical costs. So we've got $3,200 plus $7,176 totals $10,376. Their AGI for the year is $59,000. We multiply that by 7.5%. We're left with $4,425 and a medical expense deduction on line 4 of $5,951. We've also provided you with the Livingstones W-2s. We have $875 of withholding on Jonathan's first W-2. We have another $1,500 on Joanne's W-2. And on Jonathan's second W-2, we have another $1,000. So we add up those amounts and we're left with a total taxes of $3,375. The wording of the problem tells you they spent $2,500 on real estate taxes, so we've entered that on line 6, making their total tax deduction for taxes paid $5,875. Mortgage interest, as shown in the wording of the problem, is $8,000. Then on line 21, we carry the information from Form 2106. We type taxpayer 2106, $1,734. We have to apply the 2% limit based on their AGI. That's $59,000 times 2% is $1,180. That leaves them with an allowable miscellaneous itemized deduction of $554 and itemized deductions of $20,380. Let's go and take a look at their 1040 now. The Livingstones had $59,000 showing on their W-2s. That's the only income they had for the year. Their AGI and their income are the same at $59,000. Their Schedule A itemized deductions are $20,380. Their exemption deduction is $7,400, and their tax is $3,834. Their W-2s show $5,000 of federal withholding, leaving them with a refund of $1,166. So that concludes the review of the Session 10 homework answer key. At this point, please push pause on video playback. Complete the Session 10 quiz, and when you are finished, resume playback to attend the Session 11 lecture. Okay, welcome to class, everyone. Today's class is Itemized Deductions, Part 2, or Part 2 as we say. And in today's class, we're going to be covering non-business casualty losses, unreimbursed employee business expenses, office in the home, work-related educational expenses, and a whole bunch of other miscellaneous itemized deductions. So we have a lot of material to cover, and whenever I teach a class, that's usually the case. I'm always tight on time because I try to fit everything in I think is important, and there's no such thing as something that's not important in my mind, because when you sit down with a tax client, you never know what they're going to ask you. And even after 20 years of doing taxes, I routinely have a client sit down and ask me a question that I don't know the answer to that. Let me look that up. And so, of course, then I think, well, gee, if I didn't know that, then I need to put that in my class. I'm always adding material. Now, some students come to my classes simply because they need CPE, and they have to check that they have enough hours and be able to submit that they have enough hours to their State Board of Accountancy or IRS or the state licensing body that they're working with. And other people come to my classes because they're preparing for tests and they really want to be able to pass those tests. And other people come because they just really want to become better tax preparers and they think that my training will help them with that. So however you want to go with our training is of course up to you, and some students want to do a lot of work and do all of the exercises that I give them, even though it is very time consuming because they want to improve themselves. And if you're one of those persons, then I would recommend that you read the reading assignment for today's class. And the reading assignment for today's class on the simple side comes from Pub 17. And of course Pub 17 is IRS's little Bible to personal income tax, and it tries to cover pretty much everything that is in the tax code that individuals might routinely run across with enough detail to be useful. But if it's not in Pub 17, then you need to go to other sources. And sources for today's class, the reference materials I used in compiling today's class, came from IRS Publication 463, Travel, Entertainment, Gift, and Car Expenses, IRS Publication 529 on Miscellaneous Deductions, IRS Publication 547, Casualty and Theft Losses, and also Publication 1532, Daily Per Diem Rates for Travel Within the Continental United States. Now, I've used more references than this, but these are the ones that I thought would be useful that you should be taking a look at.
Session 11, password number 1 is Gandalf, G-A-N-D-A-L-F.
And with that, I'm going to move on to the next page of our manual. And this page is essentially talking about who must itemize deductions, who should itemize deductions. And the content is similar to what we covered in part 1 of itemized deductions. So I'm not going to go through it in detail. Those of you who want to read it are free to do so on your own time. We're going to move then on to the introduction for today's class and what we're covering in today's class. And of course, today's class is about Schedule A. And in specific, we're looking at the very bottom part of Schedule A, beginning on line 20, where we talk about casualty and theft losses and the rules that go into determining whether or not a person qualifies to claim a casualty loss, completion of the necessary form, and then entering the actual line deduction on line 20. Next, underneath that comes employee business expenses as well as other miscellaneous itemized deductions. Line 21 is where you enter your unreimbursed employee expenses. Line 22 is where you enter costs associated with getting your tax return prepared and filed. Line 23 is where you enter other miscellaneous itemized deductions that are subject to the 2% limit. And then, of course, then we have one more line. Line 20, it's hard to see it. Enter amount. Line 28. I'm reading on a tiny little screen. Line 28. Where we enter deductions that are not subject to the 2% limit. So we're going to be looking at all of those today. And moving on, the first topic of the day is going to be casualty losses. I like to take tax forms in the order that they have line numbers on them. So Schedule A, the casualty loss line is before the miscellaneous deductions line, and that's why we're talking casualty losses first. So as an introduction to casualty losses, the whole point of a casualty loss deduction is that it's possible you're going to be able to claim one, but only if you have a loss that you sustain in the form of a casualty or in the form of a theft. And you may not deduct casualty and theft losses that are covered by insurance unless you file a timely claim for reimbursement. And then, of course, you must reduce the loss by the amount of any reimbursement claim that you receive. A casualty loss can result from damage, destruction, or loss of your property from any sudden, unexpected, or unusual event such as a flood, hurricane, tornado, fire, earthquake, or even, IRS says, a volcanic eruption. I did just watch something on the news, like in the last year, a house on the big island of Hawaii finally
well, went under the molten lava. It had been there for many, many years, and finally it was lost. So volcanic eruptions do happen inside the United States to people. A casualty loss does not include normal wear and tear or progressive deterioration. So what we'll see when we're looking at and trying to identify a casualty loss, there's two key things that have to be identified. One is, was the loss sustained because of something the IRS considers to be a casualty or a theft? And the second thing is the amount of the loss large enough for it to have an effect on the tax return and provide a deduction that's worth claiming? So we're going to be looking first at the types of losses that are considered to be actual casualties that the IRS would allow. And of course, lots of people might want to claim things that don't meet the IRS's definition of a casualty, so we're going to spend some time today looking at what does qualify. And I'll zoom in a little so this page is easier to read. So you may be able to claim a deduction for a casualty loss, but to be deductible, the casualty must be sudden. That is an event that is swift and not gradual or progressive. Unexpected, that is an event that would not normally be anticipated and is unintended. And unusual, an event that is not day-to-day occurrence and is not typical of the type of activity in which you are engaged. So we have a chart here, and the chart's divided into two columns. The first column is examples of allowed casualty losses. These are the types of things IRS says are a casualty loss, and if this happens to your client, it is a casualty loss. Then in the next column, we have examples of disallowed casualty losses, and a lot of these are things that people obviously over time have attempted to claim on their tax return, and the IRS has not allowed them. So we're going to take a look at these because this really helps to cement in the mind when you have a casualty and when you don't. So examples of allowed casualty losses include car accidents, earthquakes, fires, floods, government-ordered condemnations resulting from natural disasters, hurricanes, mine cave-ins, shipwrecks, sonic booms, storms, tornadoes, vandalism, volcanic eruptions, damage caused by insect infestations capable of destroying a tree in 5 to 10 days. And this is something I actually saw in the news a few years ago. Some Asian beetle about yay big got into America, and it's covered with spots. It's kind of freakish looking. And yeah, it's capable of decimating a tree in hours. So not a nice bug to have come to our country. Also, death of a horse who swallowed a hat lining. Poor horse. Cracking of house foundation walls caused by soil shrinkage during drought. Collapse of garage wall from subsoil hydraulic action. Damage caused by mine cave-in even though the landslide was reasonably foreseeable. Bursting of hot water boiler in home. Damage to furniture dropped by movers. Damage caused by a flood due to faulty construction. However, the deduction is limited to the cost of the items damaged, not for the cost of reconstruction. Any damage caused by lightning. Damage to a ring inadvertently dropped in a kitchen garbage disposal. Damage to a ring caused by a car door slamming on it. Damage caused to septic tank by plowing. Damage to a beach due to abnormal rains. Damage to a home by ice and snow. Damage to a home caused by a hurricane 2 years earlier, but the damage is deductible on an amended return for the year in which the damage occurred. Damage from floodwaters caused by storms. Damage to trees and shrubs caused by accidental chemical poisoning. Damage to trees caused by storms and blizzards. Loss of trees, grass, and shrubs from fire. Damage to household items caused by vandals who broke into the home, and damage and destruction of art objects by vandals. And this one up here, accidental chemical poisoning, I was actually at a vineyard a couple of years ago here in Oregon, and they were complaining that their crop was very light this year because they had sprayed herbicide rather than pesticide on the vines. So they hadn't outright killed them, but apparently they weren't producing so hot that year. And whoever sprayed the wrong chemical was obviously in trouble. All right, so those are examples of allowed losses, allowed casualty losses. Now we're going to look at some examples of things that do not qualify as losses, and some of them are a little bit funny. Accidental breakage of household articles such as glassware and china under normal conditions. They are sudden. When you do drop it, it does break, but it's not unusual to drop and break something, so it flunks that unusual test. Damage caused by a family pet, that's not unusual either. Damage caused by a fire you willfully set or paid someone else to set, that would be not unexpected. A car accident caused by your willful negligence or neglect, that also would not be unexpected. Progressive deterioration, such as the steady weakening of a building due to normal wear and tear, well, that's obviously not sudden. Damage to a water heater that burst after it deteriorated over time, that was expected. Over time, it would weaken to a point where it gets it. Now, it would be sudden, but it would not be unexpected. Now, what the IRS did say, though, is that damage to other property caused by the burst is allowed. So although the water heater itself bursting was not considered to be a casualty, the items or property around it that were damaged as a result were allowed. Most non-business losses caused by drought, water well that ran dry because of drought, damage to shrubs eaten by a horse, damage to antique vase by a cat, damage to fur coat caused by moths, and loss of a valuable dog that strayed off. Damage caused by normal wear and tear of a car, damage to car caused by overloading the vehicle, damage to car caused by exposure to salt water, amounts you pay to someone else to compensate for your negligence. For example, a woman paid the owner of a house for damages she caused when she accidentally drove her car into it. The forced sale of a car due to divorce, damage to a car caused by potholes in the road. Now, I can remember when I lived in Virginia Beach, Virginia, and this was back in the late 80s, early 90s. There was a freeway running from Norfolk to the coast, and I swear to God it had speed bumps on it. And everyone would be clocking down that freeway at 55, 60 miles an hour with these big black speed bumps. They weren't speed bumps, but it was just the way the road had been constructed and the joints in it. And it was just bam, bam, bam. I was convinced over time that that was ruining my car, and it probably was. But IRS says it's not a casualty. The loss of a ring from an owner's finger. The loss of a ring you accidentally threw out. I did that once. Fortunately, I noticed that I'd accidentally threw it out because it was no longer on my finger, and I went to the place I thought it might be, and there it was. The accidental dropping of your eyeglasses or a watch. The loss of bandage and contents in transit. The snapping of a propeller on a yacht that was not the result of shipwreck or other casualty. Damage to trees from Dutch elm disease. The disease is progressive and not sudden or unexpected. The gradual suffocation of a tree's root system over a 16-month period, and damage to palm trees caused by lethal yellowing, termite or moth damage, and death of a horse from colic. It's an interesting comparison. The death of a horse from colic was not allowed, but the death of a horse who swallowed a hat lining was. And being a horse person, I can explain to you that although colic is sudden, it is the most common cause of death in any horse. So that would be why it's not allowed. And then loss of livestock due to disease is not allowed either. So those are examples of when you might have an acceptable casualty loss and when you will not have a loss due to a casualty. But the other way you can have a loss is through theft. And the IRS says that a theft is the taking and removing of money or property with the intent to deprive the owner of it. The theft has to be illegal under the laws of the state where it occurred, and it has to have been done with criminal intent. Theft includes the following acts: blackmail, burglary, embezzlement, extortion, kidnapping for ransom, larceny, robbery, and threats. But theft does not include lost or mislaid property. However, IRS does say that the accidental loss or disappearance can qualify as a casualty if it results from an identifiable event that is sudden, unexpected, or unusual. So if you lost your family dog in the middle of a hurricane or a tornado, that would be what I would consider an example of a casualty loss where your property is lost, and IRS would allow that. Loss on deposits. So loss on deposits occurs when a bank or financial institution becomes insolvent or bankrupt. If you incur this kind of loss, you can deduct your loss in any one of the three following ways. Number one is a casualty loss. Number two is an ordinary loss. And number 3 is a non-business bad debt. Well, what do these 3 loss categories mean? Well, under the casualty loss, you would complete Form 4684 first and then carry the loss as you've calculated it to Schedule A, line 20. That's one method of claiming it. Another method is to report the loss on Schedule A, line 23 and subject it to the 2% limit. And a third way is to claim a non-business bad debt. And to do that, you would report it on Schedule D, Form 1040. Now, ordinary loss is probably going to be a better way to do it than casualty loss because the ordinary loss limit is a lower number. But if you carry it to Schedule D, you would not have a percentage of your income reducing the loss. However, of course, Schedule D losses are carried forward over time and not allowed all at once. So those different methodologies, you'd have to experiment with each one, discuss with your clients to see which way was best for them. Proof of loss. You say you lost property, prove it. IRS says you have to prove it. The records you are required to keep differ according to whether the loss was from a casualty or theft. If it is a casualty loss, the records should show the type of casualty and when it occurred, that the loss was the direct result of the casualty, and that you were the owner of the property or that you were contractually liable for the property, and whether a claim for reimbursement exists from which you expect any recovery. If the loss is a theft, the records that you keep need to show when you discovered that the property was missing, that the property was in fact stolen, and that you were the owner of the property. Typically, they want to see that a police report was filed as well. Figuring your allowable loss. To figure your allowable loss, the IRS has a rather odd formula, and it can be confusing when you first look at it. We're used to dealing with profit and loss, say on something like a Schedule D, where you have your cost in property, you sell it for a different price, and if you sell it for more than your cost, you have a profit. If you sell it for less than your cost, you have a loss. And to a certain extent, that is what's happening with the casualty loss, but that's only one side of it. So IRS says there's 2 ways you go about determining the amount of your loss. And the first way is to look at your cost basis in that property. What did you pay for it, and how much have you lost because it's gone? So that's one way that they look at it, but it's not the only way that they look at it. The other way they look at it is this rather bizarre formula. And under that formula, it says, determine the decrease in fair market value as a result of the casualty or theft. So to determine the decrease in the fair market value, you have to do an equation that says, okay, my property before the event was worth $100,000. After the event, it was worth blank. And my loss is the difference between those 2 numbers. So if it was worth $100,000 before the event and it's worth $90,000 after the event, then I have theoretically a loss of $10,000. Now what the IRS says is that you take the lesser of your actual cost on the property or the decrease in the fair market value. So in that scenario I gave you, you've got property worth $100,000 before the event, worth $90,000 after the event, for a difference in fair market value of $10,000. But what did I pay for that property? That's important. Let's suppose I paid $80,000 for the property. The IRS says that my loss is going to be the smaller of the decrease in fair market value or my basis. And in this case, the decrease in fair market value is 10, and the basis is 80, so the loss would be limited to the 10. So it's not at all intuitive, but that's how they want you to calculate it. So what is fair market value? Well, fair market value is the price at which the property would be sold between a willing buyer and a willing seller, each having knowledge of relevant facts, and really neither being in a situation where they're forced to buy or sell. Difference in fair market value. The difference between the fair market value immediately before the casualty and theft and the fair market value immediately after represents the decrease in fair market value because of the casualty. The fair market value of the property, if the fair market value of the property, actually let's read this. So the fair market value of property after a theft is 0 if the property is not recovered. But obviously if it was recovered, then it might have been damaged. So you would be looking at those 2. And fair market value is generally determined by competent appraisal. So who would do an appraisal? Well, there are people out there whose professional job is to do appraisals, and you would track one down. Replacement cost or the cost of repairs is not necessarily fair market value. However, You may be able to use the cost of repairs to the damaged property as evidence of the loss in value if the repairs are actually made, the repairs are necessary to restore the property to the condition it was in immediately before the casualty, the amount spent for repairs is not excessive, the repairs only correct the damage caused by the casualty, and the value of the property after repairs is not, as a result of the repairs, more than the value of the property immediately before the casualty. So what IRS is saying is you really should have an appraisal. But let's just suppose you don't get an appraisal, and instead you just go ahead and repair the property. Can you use how much it cost you to repair the property as proof or evidence of the loss in value? And the IRS says yes. If that's what you've got to work with, they'll consider that. But they want to make sure that the repairs are not improving the property so that it's worth more as a result of the repairs than it was before the casualty occurred. Leased property. If you are liable for casualty damage to property that you lease, your loss is the amount that you must pay to repair the property minus any insurance or other reimbursement you receive or expect to receive. Separate computations. Generally, if a single casualty or theft involves more than one item of property, you have to figure the loss for each item separately. You then combine the losses to determine the total loss from the casualty or theft. Now, if you go to IRS Publication 584, Casualty and Theft Worksheet, or Theft Loss Worksheet, that particular publication is pages and pages and pages of worksheets that you use to list each and every item of property that you lost. It goes room by room in your house and has a lot of the worksheet already filled out for you. Couch, what I paid for it, when I bought it, value before, value after. Lamp, when I bought it, how much it cost me, what it was worth before the event, what it's worth now. Page after page after page of worksheets. Now, you clearly don't have to use those worksheets. You could set up an Excel spreadsheet in your computer and do it there. But they do want to see you go through and list every single item of property that was lost or destroyed. Now, if you have a loss on real estate, you can do things a little bit more easily. And we're not talking about the contents inside a home, but we're talking about the home itself. So, of course, you have the home, and you have the roof on the home, and you have the furnace, and you have the landscaping, you have the deck, right? You have fixtures around the house. That's what they mean when they say real estate. They're not talking about all the personal property you have inside the house, but really the house itself. If you were to sell it and walk away from it, everything that is a part of the house. So when you're talking about a loss on real estate, you apply the following rules. IRS says to measure the decrease in value of the property as a whole, and all improvements such as the building, trees, and shrubs are considered to be one item. You figure the loss separately for other items. If, for example, you figure the loss separately for each piece of furniture in the home. Insurance and other reimbursements. You must reduce the loss by the amount of insurance reimbursement that you received or will receive. Here's an interesting rule. The IRS says that if you fail to file a claim for reimbursement, you can't claim the loss to the extent you could have received that reimbursement. So IRS is essentially saying it is mandatory that you file a claim. And if you don't file a claim, you're not going to be allowed to claim a loss to the extent that a claim would have allowed you to recover on that cost. Insurance payments for living expenses. Your casualty loss is not reduced by insurance payments that you receive to cover living expenses in either of the following situations. You lose the use of your home because of a casualty, or government authorities do not allow you to access your main home because of a casualty or the threat of one. So, for example, we say on the news that there's wildfires in California and the government orders everyone to vacate their home and leave the area. Now they're incurring expenses for hotel and travel because they can't live in their own home. And IRS says if you're ordered to leave your home by the government authorities and you have household insurance that provides compensation for that, that will not be deemed to be an offset to the loss in the property, or won't apply against the property. Now, there is a provision for inclusion in income when it comes to insurance payments. If the insurance payments you receive are more than the temporary increase in your living expenses, you must include the excess in your income, and you report it on line 21 of your Form 1040. However, if the casualty occurs in a federally declared disaster area, then none of the insurance payments are taxable.
Session 11 password number 2 is Bilbo, B-I-L-B-O.
Figuring a gain. If the amount of insurance payment or other reimbursement that you receive for the loss on your property is more than your basis in the lost property, you have a gain from the casualty or theft. And to figure your gain, you need to subtract the insurance payment or other reimbursement from the loss. The difference is a taxable gain, and you report the gain on Schedule D. So let's look at some of the rules surrounding the deduction limits on casualties. Obviously, you have to have a loss, and you have to figure out how much it is. Once you've figured out how much your loss is, now you have to figure out how much you are allowed to deduct. And there are a number of rules that apply to the deduction. The first rule is the $100 rule. And you need to reduce each casualty or theft loss that occurred during the year by $100. There's also a 2% rule, but this rule does not typically apply to the casualty loss line on the tax form. So we're looking at line 20 of Schedule A. If you're applying the 2% rule, you would not be reporting the loss on that line. You would be carrying it to a miscellaneous employee business expense line instead. So for most people, we look at the $100 rule, and then we also look at the 10% rule. For the 10% rule, you have to reduce the total of all casualty or theft losses of your personal use property by 10% of your adjusted gross income. And here's an illustration of what we mean by applying the $100 rule and the 10% rule, which most of the time when we're talking casualty losses associated with personal property, we're talking about the $100 rule and the 10% rule working together. Here's the illustration. Your boat was stolen. The boat cost you $20,000. Its fair market value on the date that it was stolen was $15,000, and your insurance paid you $13,000. Your adjusted gross income for the year is $29,500. So the first thing we do is we look at how much the loss was. The fair market value of the boat before the event is $15,000, and the fair market value after the event is $0. But then insurance kicks in and pays out $13,000. So we start with a $15,000 loss in fair market value and subtract out the insurance claim to get a loss of $2,000. The next step is to subtract out $100, and that leaves us with a loss after the $100 rule of $1,900. The next step is where everything goes to heck. We lose out and don't have a deduction. We have to subtract 10% of the adjusted gross income, and 10% of $29,500 is $2,950. $2,950 is more than $1,900, so the loss allowed is $0. Let's look at another example. Here in illustration 2A, we have multiple losses from a single event, just so that you can see how the $100 rule applies to each event only once. Your home was destroyed in an ice storm. A tree collapsed onto your roof, causing extensive damage to the house and the property inside. The fair market value of your home before the storm was $150,000, and the fair market value of the home after the storm was $120,000. You paid $130,000 for the home. So what have we got here? We've got a cost in the home or a basis in the home of $130,000. We have fair market value before the event of $150,000 and fair market value after the event of $120,000. The difference in fair market value would therefore be $30,000. Now you also had belongings that were destroyed by a falling tree, and they had a fair market value of $4,000 before the storm and a fair market value of $0 after the storm, and you paid $12,000 for those belongings. Your insurance reimbursed you $9,000, and your AGI is $29,500. So the fair market value of our property, the belongings inside the home before the event was $4,000. After it was $0, so that's a loss of $4,000, and we have a basis of $12,000. Insurance for the total loss combined is only $9,000. Let's see how it pencils out. So we look at the assets damaged. We have a house valued at $150,000 with a fair market value, that is, of $150,000, and we have belongings of $4,000. Now for simplicity in this illustration, I've compiled all of the household belongings into a single line item description, but in reality, you should actually list every one of these out. that would be a rather dull exercise for this class, so I just lumped them together. So we have 4,000 plus 150. That's the fair market value of all of the property combined before the event. 154 is the total. We then look at the fair market value of all of the assets after the event. We have a house that's now worth 120 and belongings that are worthless. So we have fair market value after the event of 120. So fair market value before, fair market value after, the total loss is $34,000. Now the total loss after insurance reimbursement, we're going to take $34,000 and subtract out the $9,000, and that gives us a loss of $25,000. Next step, we look at the $100 rule and the 10% rule. And under the $100 rule, we take the loss and we subtract out $100. We then subtract out 10% of the adjusted gross income, and that gives us the casualty loss deduction. And this is the amount that we would be able to enter on line 20 of Schedule A. Moving up, we look at another illustration. This illustration has all of the same facts, except later that same year, your $1,500 ring is stolen. So now we have two events. In the previous example here, we had a single event. And under the single event, we apply the $100 rule once and the 10% of our AGI rule. Now we're moving up to multiple events. When we have multiple events, you actually have to fill out the Casualty Loss Form 4684 twice. You would need one 4684 for each event, but you have only one 4684 for all of the property lost within a single event. So if you lost 1,000 items in a big storm in your house, all 1,000 items from that one event would go on the same 4684. And then in a separate event, the ring is stolen. That's a separate 4684, even though it's only one item. Okay, so let's look at all of these same facts again. House is worth 150 before the event, the belongings are 4,000 before the event, and the ring is 1,500 before the event. So the fair market value of all assets before loss is 155,500. Then we look at the fair market value after the event. The house is worth 120, the belongings inside the house are 0, and the ring is 0. The total fair market value of assets after the loss is $120,000. Then we look in the total difference or total amount of the loss. We take 155.5, subtract out 120, and we get 35.5. Now our last illustration, of course, that number was 34. This is exactly $15 to $100 higher because that's the cost of the ring or the value of the ring. So what's the loss in fair market value? Well, we take 35.5, subtract out insurance reimbursement, and we get 26.5. Now we need to apply the $100 per event rule and the 10% of AGI rule. So we start with the loss of $26,500. We subtract out $100 for the falling tree event. We subtract out $100 for the stolen ring event. And then we subtract out 10% of the adjusted gross income. And that gives us a loss of $23,350. Now, what if we have a loss on business or income-producing property? Well, I did briefly mention that earlier. The loss on business and income-producing property is not limited by the 2%, 10%, or $100 rules. If your casualty or theft loss involved a home that you used for business or rented out, your deduction may still be limited. To claim a business casualty loss, you'll need to complete Form 4684 Section B. Now today for our classwork exercises, we're going to be looking at Form 4684 Section A. If you do get into a business casualty loss situation, you would complete Section B instead. If the business casualty or theft loss involved property used in a passive activity, you do need to pay attention to the passive activity loss limitations and complete Form 8582. So when do you deduct a loss? Well, it depends on the type of loss. And when do we deduct it? IRS says this is the year in which you deduct it. If you have a loss on a deposit that you treat as a casualty, you claim that in the year you reasonably estimate that the loss incurred. If you treat it as a bad debt, you take it the year the deposits become totally worthless. And if it's an ordinary loss, you claim it in the year you reasonably estimate that the loss occurred. From a casualty, you claim the loss in the year that the loss occurred. But if the casualty loss is in a federal disaster area, you can claim the loss either in the year the disaster occurred or the year immediately before the disaster. And if the loss is from a theft, you claim it in the year that you discover the theft. So there are some special rules for federally declared disaster areas. You can reference those in Publication 17, page 172. As with other personal losses, disaster losses are subject to the $100 rule and the 10% of AGI limit, and they are deductible only if you itemize your deductions. But if you live in a federally declared disaster area, you are given some special treatment. For example, you can claim the loss on your return in either the year the event occurs or in the year immediately before the year the casualty occurs. Now, why would this be the case? Well, you could look at, say, the people who lived in the zone of Hurricane Katrina when that event happened. It happened in the summer. Clearly, the area was decimated, and the people living there had little or no income coming to them after that event. They had an enormous loss, but they may not have had an ability to take that loss and offset very much income. Now, of course, if they did claim the loss in that year, they could have an NOL that they could carry back. That would be an option. But another option is to go back to the earlier year where perhaps they did have more income, and offsetting the loss in that earlier year might be able to give them a greater tax benefit. Or it could be the opposite. If I claim the loss this year, this could have been a high income year. That 10% of my AGI is really taking away a good part of the deduction, but in the earlier year my income was lower, 10% is less, and if that could give me a better benefit there. So you're essentially being given a choice, and which choice is best would depend on the facts and circumstances of that particular client's case. Also, if you live in a federally declared disaster area, there is interest abatement. The IRS will abate interest on taxes you owe for the length of your extension if you meet the following requirements. Number one, you were located in the area declared a disaster by the federal government, and you were granted an extension to file your taxes, and you actually paid your taxes. So where do you deduct your loss? Well, we've been telling you that you typically will claim a personal casualty loss on Schedule A on line 20. And what I've done for you here is I've got the form on the screen, and we're going to take a look at it line by line. Line number 1, this is where you describe each item of property lost from a single event, from this event. And there's space provided for each item of property lost, and clearly if you have more items of property than they provide space for, you would need to attach a statement that contains the rest of the required information. Then on line 2, we take these lines for property A, and it would correspond to column A. Property B would correspond to column B. So for the property described on line A, on line 2, you're going to enter the cost. Then for line 3, it asks you to enter any insurance or other reimbursement you received. Then on line 4, if your insurance reimbursements are greater than your cost, you enter the profit or gain on line 4. If there is no profit or gain, you do not enter an amount on line 4. Line 5, you enter the fair market value of the property before the casualty. And on line 6, you enter the fair market value of the property after the casualty. Then on line 7, you enter the difference in fair market value. The difference in fair market value is, of course, one of the restrictions that we look at, and the other restriction is the basis. And of course, our cost basis on line 2 is then the number that we're looking at, and we're comparing that to the amount on line 7. And whichever is the smaller amount is the amount that we're going to use. Then on line 8, it says compare your cost basis in the lost property with the amount of decrease in the fair market value and enter the lesser of those two numbers. Line 9, subtract your insurance reimbursement from the lesser of your cost or the decrease in fair market value to determine the amount of loss you have associated with that piece of property. Lines 10, 11, and 12, you add up the total of all of the losses from all of the columns and enter the total loss on lines 10, 11, and 12. Then on line 14, you enter the total gain from insurance reimbursements. On line 15, if the gain from insurance reimbursements is more than your loss, enter the net gain from all losses on the line and then carry the profit to Schedule D. And of course, you do see here on line 11, enter the smaller of line 10 or line or $100. So IRS is saying if your loss is less than $100, you're done. All right. And then on line 16, reduce the total of all losses by the total of all gains. Line 17, that's where we're going to enter 10% of your income. And back up here on line 16, you're going to look at all of your Forms 4684 and enter the losses from all of the Forms 4684. Then you go in and you enter 10% of your income. And of course, you subtract line 17 from line 16 to get the net loss. And that net loss would carry to Schedule A, line 20. If you are a person who is filing Form 1040NR, you would carry that to line 6 on the 1040 NR. I've mentioned net operating loss a couple times. If your casualty or theft loss is more than your income, you may have an NOL, and you can carry an NOL back to a prior year to get a refund of taxes you already paid, or you can carry it forward to next year. Damage from corrosive drywall. Under a special procedure, you may be able to claim a casualty loss deduction for amounts you paid to repair damage to your home and household appliances that resulted from corrosive drywall. And if you want to know more about that, see the instructions or publication 547. So this is a table that I pulled out of IRS publication 547. It's table 2 from that publication. It does a nice job of essentially summarizing the rules and how they are applied, and how they are applied as well when you have a loss that is going to more than a single person. Because you could, of course, have a married couple that own the property that's lost. You could have co-owners of property, and what happens in situations like those. So for the $100 rule, the general application is that you reduce each casualty or theft loss by $100 when you figure your deduction. And you apply this rule to personal use property after you have figured the amount of your loss. For the 10% rule, you must reduce your casualty or theft by 10% of your AGI, and you apply this rule to personal use property after you reduce each loss by the $100 rule. And for the 2% rule, you reduce your total casualty or theft loss by 2% of your AGI. You apply this rule to property you used in performing services as an employee after you have figured the amount of your loss and added it to your job expenses and most other miscellaneous itemized deductions. So a casualty loss that is associated with employee property that you use in your business for your work would be considered to be an expense of being an employee rather than a personal loss. And that's why it carries to that line. Next, we have the single event. When it comes to the $100 rule, you apply this rule only once when there's a single event, even if many pieces of property are lost. The 10% rule, we apply this rule only once, even if many pieces of property are affected. And for the 2% rule, we apply this rule only once, even if many pieces of property are affected. Now, if you have more than one event, you apply the $100 rule to each event. But the 10% rule still applies only once, even though you might have many events. And the same is true of the 2% rule. Now, what if more than one person sustains in the loss? Does the $100 rule apply only once, or does it apply twice? Well, the answer is it would apply individually to each person, and the 10% of income would apply individually to each person. So if two persons share a single loss, they're each going to have to report their own loss on their own return. The $100 rule will apply on each of their returns, and the 10% rule will apply on each of their returns. Now, with a married couple who file a joint return, you're going to file a single return, and the loss, you apply $100 once to that single return, 10% once to that single return. But if you file separately, the $100 rule will apply to each spouse separately on each of their separate returns, as will the 10% rule. And if there is more than one owner, then, of course, you apply separately to each owner on each of these items. So if you incur a casualty loss or a theft loss in your trade or business, you're not going to fill out Schedule A to claim your loss. You're going to carry the loss completely to a different form, and it's typically going to be the business form that you're filing. Also, when you have a loss sustained in a business, the $100 and the 10% rules do not apply. If the loss occurred to employee use property, however, there is that 2% limit. But if it's a business, like you're self-employed or you're a farmer filing a Schedule F, or you have an S corporation or a partnership, the losses are actually going to be claimed on those business returns. And in those situations, again, the 10% rule, the $100 rule, the 2% rule do not apply. The loss is allowed in full. However, this difference in fair market value concept kind of goes away, and we're instead looking at cost. So if your casualty or theft loss is associated with a business activity that is reported on a Schedule C for self-employment, a Schedule F for farming, Form 1120S as S corporation, or Form 1065 for a partnership, then if the property was completely destroyed, the loss is generally the cost of the property minus depreciation. Fair market value that is less than basis really does not reduce the allowed loss. If the property was damaged but not destroyed, the loss is generally the decrease in the property's fair market value up to the adjusted basis, but of course not more. Loss of inventory. There are two ways that you can deduct a casualty or theft loss of inventory, including items that you hold for sale to customers. The first way is to deduct the loss through the increase in the cost of goods sold by properly reporting your opening and closing inventories. The loss will be claimed through a reduction of inventory. So what that means is you open the year and you have $10,000 worth of inventory for your restaurant. There's a flood and all of the inventory is lost. Well, obviously, now you have zero inventory. So the loss is just going to be sustained in that difference in inventory. So that's one method. The other is to deduct the loss separately. And to deduct the loss separately, you must eliminate the affected inventory items from the cost of goods sold by making a downward adjustment to the opening inventory. So in the earlier illustration, I said your opening inventory is 10. Now they're saying you could instead say, hey, my opening inventory is 0. You then reduce the loss by the reimbursement that you receive, if any. Do not include the reimbursement in your income. And if you do not receive the reimbursement by the end of the year, you do not claim the loss to the extent you have a reasonable prospect of recovery. So this is, of course, assuming that there's insurance that's coming along. Cost of repairs. The cost of repairing damaged property or cleaning up after a casualty must be capitalized if the owner takes a casualty loss deduction for the property. And the IRS has a memorandum, 2006-006, that you can read for more information on this. So this is actually one of the things that kind of gets people. You have a casualty loss and you claim the loss. And very often you then have to go out and replace the property. And when you buy the replacement property, you can deduct it again. Of course, your loss can never be more than your cost. So let's look at what you might have that you could lose. And one of the examples we gave was inventory. But let's look at another kind of asset. Let's say a vehicle that you use in your business. And let's suppose it's a vehicle that you paid $30,000 for. And at the time of the event, it had an adjusted basis of $20,000. So you paid $30,000, but now it has an adjusted basis after depreciation of $20,000, and the vehicle is a total loss. Insurance comes in and gives you $10,000. So the casualty loss would then be $10,000. Fair market value of $20,000 minus insurance of $10,000 leaves us a loss of $10,000, and you claim the loss on your business. Then you go out and buy another $30,000 car, but oh wait, it's a bonus depreciation year. I can write that sucker off, or a good portion of it off. And so am I allowed to do that in the same year that I'm claiming a casualty loss for the car I'm replacing? And the answer is yes, you can do both because you treat each event separately. All right, so where do we claim a casualty or theft loss for a business? Well, you would do that on page 2 or section B of the Form 4684. I have the form up so you can take a study of it if you want to, but we're not going to cover it because this is a Schedule A class after all. So that's the end of employee expenses. We're going to now move on in the final few minutes we have left in our class today to talk about some of the other expenses that you can be able to claim. And I've put a series of charts in here. The first chart is allowable deductions as employee business expenses that are subject to the 2% limit. And since we've been through most of these, I'm going to scoot by them. But what I have done for you is I've documented the type of expense and how you would go about claiming that on your tax return, which form is required, if any, and so forth. The next category is tax preparation fees. Those are deductible, and how do you deduct them? Well, most clients will claim tax preparation fees on Schedule A, line 22, but if a portion of the fee for tax preparation can be associated with a business, you would claim the portion associated with the business directly on Schedule C for self-employment, obviously Schedule F if you're a farmer, or on Schedule E if you have rental property. So a high number or a high percentage of my clients actually have rental property or businesses, and so I'm really in the habit of splitting up my tax preparation and applying it, some to Schedule A and some to these other forms. Then we have other miscellaneous deductions that are subject to the 2% limit. And typically, if you want to claim a miscellaneous itemized deduction that is not an employee business expense, you're going to have to be able to show that you've incurred the expense to produce or collect income that has to be included in your income, to manage, conserve, or maintain property held for production of income, or determine, contest, pay, or claim any refund of any tax. You can deduct expenses you pay for the purposes of 1 and 2 above only if they are reasonable and closely related to those purposes. And IRS Publication 529 describes expenses that may be deductible, many of which are described in the table that follows on the next page. Now, one of the items that I keep getting yammered at by my customers and my employees is, what about when I have a loss on an IRA? This isn't a class about IRAs at all, but it is a class about miscellaneous deductions, and it happens to be that it is possible to claim a miscellaneous deduction for a loss on your IRA, so I decided to throw it in here. Now, whether you have a traditional IRA or a Roth IRA, essentially the rule is the same. If you have a loss on your traditional account, your IRA account, you can claim a loss on your income tax return, but only when all amounts in your traditional IRAs have been distributed to you and the total distributions are less than your unrecovered basis is any. Well, in order to have a basis in a traditional IRA, you have to make contributions to that IRA for which you were not allowed to claim a deduction. Most people have little or no basis in their traditional IRAs. So, and you have to track your basis in your traditional IRA with a form called 8606. We talked about that in our adjustments to income class. Now, Roth IRAs typically will always have a basis because you're not allowed to claim a deduction for what you put into a Roth. And lots of investment advisors get excited and tell their customers to put their money into Roth IRAs, and so the customers do that. And then the customers come into me and they can say things like, well, I put all of my money into a Roth IRA, or I rolled my money from my traditional into my Roth and I paid tax on all that income, and now the Roth has gone down in value. Can I claim a loss on that? And the answer is, if you completely distribute all the money in the Roth accounts, close them out. If you do that, now you have realized the loss, and the loss is going to be the difference between what you deposited into those accounts and what you were able to distribute. And to the extent that you have a loss, you do get to claim that as a miscellaneous deduction on Schedule A, subject to the 2% limit. Now, here are some of the other types of deductions that you can claim on Schedule A subject to the 2% limit. Appraisal fees for donated property or to compute the cost of a casualty loss. So we talked about casualty losses at the beginning of today's class, and in that we said when you have a casualty loss, you have to reduce the loss by 10% of your income. But to even figure out what the loss is, you have to look at the fair market value of the property before the event and the fair market value after the event, and you have to pay an appraiser to do that. And can I claim the cost of that appraisal fee as an itemized deduction? The answer is yes, but not under the casualty loss provisions, but as a 2% limit deduction. Casualty or theft loss of business property but used by you as an employee. You would fill out Form 4684 and or Form 4797, and then you would carry the deduction to line 23 of Schedule A rather than to line 20. Clerical help and office rent connected with investment income, that is also deductible on line 23. Depreciation of home computer to manage investments, yes, but I have to attach a Form 4562 first. Excess deductions of an estate, fees to collect interest and dividends, hobby expenses to the extent of hobby income, indirect deductions of partnerships and S corporations and non-publicly offered mutual funds, investment fees and expenses, legal expenses paid to produce or collect taxable income, loss on deposits with insolvent or bankrupt financial institutions, repayment of income of $3,000 or less, repayment of Social Security benefits is greater than the benefits received by $3,000 or less, safety deposit box rent used to store taxable income producing documents, service charges on dividend reinvestment plans, trustees' administrative fees for the IRA, but only if the fees are paid from non-IRA sources to the custodian. So if you have an IRA account and you are paying a custodian a fee each year to maintain that account, and that fee is not being withdrawn from the account or paid from inside the account, then it is deductible. Losses on complete distribution from traditional or Roth IRA and convenience fee charged by the credit card processing company for paying your income taxes by credit cards are all examples of things that can be deducted there. Now, what are some things that are not subject to the 2% limit? So I've listed items that are claimed on line 23 subject to the 2% limit. There's also some deductions that are claimed on line 28 that are not subject to the 2% limit. These include amortizable premium of taxable bonds, casualty and theft losses from income property such as stocks, vacant land, and works of art, federal estate tax on income in respect of a decedent, gambling losses up to the amount of gambling winnings, Impairment-related work expenses for individuals who have physical or mental disabilities. So that's a rather interesting one. So if you're an employee who has a difficult time seeing, so you have special glasses or special attachments that go on your computer to make it blow up, that would be an example of a deduction you could claim on Schedule A, and it would not be subject to the 2% limit. Repayments under claim of right greater than $3,000, including repaid wages. Repayment of Social Security benefits that is more than the benefits received by more than $3,000. Uncovered investment in annuity on final return of a decedent. Officials employed by a state or local government on a fee basis. And travel expenses of a reserve or National Guard service members who travel away from home more than 100 miles overnight. But you'll notice that the fee basis government officials and the travel expenses of reserve and National Guard members, you report those expenses on 2106, but you don't carry them to Schedule A. You don't enter them on line 28. You carry to the front page of the tax return on Form 1040 and enter them as an adjustment to income. Here's an illustration of how all of these different types of deductions might cement together on a Schedule A. Hugh Grant has adjusted gross income of $172,000, and he had the following expenses. Gambling losses to the extent of winnings are $2,000. Tax preparation fees are $250. He had educational expenses of $7,500 and a deductible hobby loss of $500. Well, the education expense is job related, and it's going to go on the employee business expense line, line 21. Obviously, tax preparation goes on line 22, where it says enter your tax preparation fees. The hobby expenses to the extent of hobby income are entered on line 23, but it means he needs to enter hobby income on line 21 of his tax return as well, his 1040. And then down here on line 28, the gambling losses sticks out by itself down at the bottom, $2,000. And of course, we take lines 21, 22, 23, and add them together. And the total is on line 24. We then take line 25, enter his AGI of $172,000, multiply that by 2%, and we get $3,440. $3,440 is subtracted from the amount on line 24, giving him a deduction of $4,810, and to that we add the gambling losses. Next, we have examples of non-deductible expenses. These again come from publication 529. Some of them are also listed in Pub 17. These are specific things that the IRS has gone out of its way to say no about, and some of them are items that my clients ask me about on a regular basis, so it's nice to be confident. Things that you cannot deduct include broker commissions paid in connection with your IRA or other investment property, burial or funeral costs, capital expenses such as equipment, buildings, and other assets. Now, they may be deductible in other ways, but they're not deductible as miscellaneous deductions, all right? Fees and licenses, including car, marriage, and pet licenses, well, that's not deductible anywhere else. Hobby losses that exceed hobby income, no. Home repairs, insurance, and rent, no. Illegal bribes and kickbacks. Wasn't that on the news? Some governor in Illinois? Yeah, no. Loss on the sale of personal property, such as your home, car, or other personal property not used for business. Personal disability insurance premiums. Personal living or family expenses. The value of wages never received or lost vacation time. Campaign expenses even if the candidate is running for re-election. Check writing fees on your personal account. Club dues, including clubs where you meet to discuss business. Commuting expenses. Entertainment facilities such as yacht, ballroom, clubhouse, hunting facility, swimming pool, tennis court, bowling alley, car, airplane, apartment, hotel suite, or home in a vacation resort. No, no, and no. Fines or penalties not deductible. Health spa expenses, home security system, homeowners insurance premiums, investment-related seminars, life insurance premiums, lobbying expenses, lost cash or property, meals with coworkers, meals while working late, personal legal expenses incurred for such things such as child custody, breach of promise, civil or criminal charges, personal injury, preparation of a will or divorce, political contributions, professional accreditation fees, professional reputation, relief fund contributions, residential local telephone service. Even if you use your phone for business, to claim a telephone business expense, you must have a second phone line installed for business use. The rationale on this is that the IRS assumes you would have a regular phone line anyway, And this is a rationale that's been around forever, but of course in modern times, a lot of my clients don't even have a regular phone line anymore. All they have is a cell phone. And the interesting thing is that with a cell phone, the IRS says, what was the percentage business use? My client says it's 80% business, and the IRS guy says, okay, and gives it. But on the home phone line, even if it's 90% business use, or the only reason you have it is for business, the IRS says no if it's the only line you have. Stockholders meetings, not deductible. Tax-exempt income expenses. You cannot deduct expenses you pay to produce or collect tax-exempt income. Travel as a form of education is not allowed. Travel expenses for another individual, such as a spouse, not allowed. Voluntary employment fund benefit contributions, not allowed. And wristwatches, they're not allowed either, even if your job requires you to be there on time. Not allowed. Okay, we're at the end of our time, and I still wanted to spend a couple of minutes talking about alternative minimum tax because it does affect people. This is not an in-depth discussion of AMT. I have a whole class, 4 hours long, where I will do nothing but talk about alternative minimum tax. But for today, I did want to give you an introduction to it because when you claim itemized deductions, the odds of alternative minimum tax kicking in and affecting you go up. And in particular, there are certain kinds of expenses claimed on Schedule A that can trigger AMT quite quickly. So the tax law gives special treatments to some income and some deductions under the regular tax. But under alternative minimum tax, these deductions may be reduced or thrown out completely. And what happens under the regular tax is you figure your income, you figure your deductions, and you come up with something called your taxable income. Under the alternative minimum tax, you take your income after you itemize your deductions, and then you start adding things back in. For example, under the regular tax, you are allowed to claim a deduction for real estate taxes you pay on your home or other investment land. You are also allowed to claim a deduction on Schedule A for miscellaneous employee business expenses and for medical expenses and for home mortgage interest expenses that you pay. And under AMT, some of those are allowed and some are thrown out. The biggest ones that get thrown out are taxes, so deductions for state and local income taxes are thrown out, and the next one in line is employee business expenses. Right up there with being thrown out also is dependency exemptions. Those are not allowed either, but they're not claimed on Schedule A. They're thrown out in a different way. So to calculate your income for alternative minimum tax, you have to figure that under alternative minimum tax rules, you will not be allowed a deduction for your dependents or yourself. You will also not be allowed to claim a standard deduction under alternative minimum tax. If you are itemizing under the alternative minimum tax, you are not going to be allowed to claim a deduction for state and local income taxes, certain interest, most miscellaneous deductions, and some of your medical expenses. So in essence, AMT is going to add back any of the tax deductions you claimed for state and local income taxes, but AMT does not tax your state and local refunds. Also, if you claim depreciation for your business, alternative minimum tax may treat that depreciation differently. There can be a difference in how you calculate gain under the alternative minimum tax. If you sold an asset at a gain, how alternative minimum tax treats that and how the regular tax treats that could be different. Also, the addition of certain income from incentive stock options. If you are an employee who exercised incentive stock options, you may have to add to your income under AMT. If you have passive activity loss deductions, AMT may treat those differently, as well as depletion, intangible drilling costs, and finally, in tax-exempt interest. So are you going to be impacted by AMT? Do you need to care about AMT? Well, based on your filing status, the possibility of triggering AMT happens when your income hits these numbers, and it's not very high. Most people do not find themselves in a world where they're paying alternative minimum tax until, as a single person, your income hits probably $150,000, and as a married couple, when your income hits around $220,000. That's when I see most people getting impacted by AMT, when their incomes exceed those amounts. But it is theoretically possible to be subjected to the alternative minimum tax at much lower rates of income, as low as the ones you see here.
Session 11 password number 3 is Dragon, D-R-A-G-O-N. It is now time to review the classwork assignment for Session 11, and the classwork assignment will involve preparation of Schedule 8 and Form 4684 for figuring a casualty loss. Katrina Brewer is single. Her AGI is $47,229 for 2011, and her 1098 mortgage interest statement says that she paid $5,000 of mortgage interest and that her property taxes were $1,000 for the year. Katrina also has $1,829 of state withholding showing on her W-2. On January 15, 2011, Katrina's home, personal belongings, and car were destroyed by flooding. At the time of the flood, she lived at 123 Pacific Street in South Egremont, Massachusetts, and she had the following casualty losses for the year. The house has a cost basis to her of $200,000 and a fair market value before the disaster of $235,000. The fair market value afterwards is a complete loss. It's worthless. Insurance gave her $185,000 to compensate her for her loss on the house. Personal belongings were $45,000. The fair market value before is $29,000. Fair market value after is $0, and also she lost her car. The cost was $26,500. The fair market value before is $15,000, and the fair market value after is $0. And these are the insurance reimbursements that she received. So your job is to complete Katrina's Schedule A and 4684. So please push pause on video playback. Complete the classwork assignment involving Katrina Brewer. When you are ready, please resume video playback for a review of the classwork answer key. I now have the answer key for the Session 11 classwork assignment up on the screen in front of you, and I've actually started it with the Form 4684 first. I would think by now the rest of this assignment is pretty elementary for you, involving the rest of the items that you claim on Schedule A, and this is the big part that you would have spent your time on. So let's just take a look at the entries that we have made on Form 4684 and compare those to the wording in the problem. The first thing is we've listed a house, personal belongings, and a car. And what you do need to know is that the IRS would require that every item be listed on the Form 4684, but for simplicity purposes, we've lumped personal belongings as a single category. We don't want you to spend all day listing items. But if you really did have a client who had a casualty loss and everything they owned was destroyed, IRS would expect a statement that includes a listing of all of the individual items that were lost. So let's take a look then at the descriptions. We have property A, which is the home, property B, which is the contents of the home, and property C, which is the Ford Explorer. These columns correspond to the columns going across the screen here. And on line 2, we enter the cost basis. We can show you cost basis here, so $200,000 in the problem will carry up to $200,000 on the answer key. 45 goes to 45, and 26.5 goes to 26.5. Similarly, the fair market value before the event is carrying to line 5, $235,000, $29,000, and $15,000 respectively. And the insurance reimbursements in the far column are carrying to line 3 at $185,000, $27,000, and $11,000 respectively. And finally, we have the fair market value after the event, and we said the fair market value after the event was 0. So line 6 is 0 all the way across. Then we get to line 7, and it says subtract line 6 from line 5. The loss is going to be the lesser of the difference between fair market value or cost after subtracting out any value after the event. Since the value after the event is 0, line 7 and line 5 are the same. On line 8, it says take the lesser of or the smaller of line 2 or line 7. Line 7, of course, being the fair market value before the event, and line 2 being the cost basis. You get the lesser of those two numbers. So for the house, the lesser amount is the basis. For the belongings, the lesser amount is the fair market value, and for the car, the lesser amount was the fair market value. Next, from line 8, we subtract the insurance reimbursement showing on line 3, and the net loss after insurance is now showing on line 9. So the loss after insurance on line 9 is $15,000 for the house, $2,000 for the belongings, and $4,000 for the car. The total loss adds up to $21,000. Now we have to apply the $100 rule per event. That's $100, and that gives us a loss of $20,900. The next step is to take 10% of Katrina's adjusted gross income. And her AGI, we give you that in the wording of the problem, is $47,229, and 10% of that is $4,723. We subtract $4,723 from $20,900, and we're left with $16,177. Now it's time to move up and complete her Schedule A. And we begin Schedule A by entering that $16,177 on line 20. Above that, we've entered all of the other deductions that we gave you in the wording of the problem, including income taxes withheld under W-2, real estate taxes, and mortgage interest. All of those deductions added to her casualty loss give her total itemized deductions on line 29 of $24,006. So that concludes the review of the Session 11 classwork assignment. Let's take a look at the homework assignment for Session 11 next. And the homework assignment begins on page 25 of your Session 11 student manual. Our character this time is James Kirk, or Jim Kirk. He is single, and he has a son who lived with him all year. The son is born in 2001. Jim is a starship captain. His W-2 is attached. He won $59,250 from the state lottery, and he donated the following items to charity during the year. Your job is to sort through all of that, figure out what he can deduct and cannot deduct. He also had a comic book collection that was valued at $50,000. It was stolen, and his records show he had a cost basis in the collection of $30,000. His insurance policy only gave him $5,000 for the loss. Then it was a very unlucky year for Jim. He also had a prize stamp collection. It was destroyed when his pet Tribble ate it. The collection had a fair market value of $2,000 and a cost basis of $500. It was not insured. He also has the following medical expenses and other deductions for the year. Your job is to sort through all of these pieces of information and prepare his federal tax return. His W-2 is shown at the bottom of page 26. And that concludes Session 11 of the Basic Tax course. I will see you next time as we start on Session 12. Bye-bye.